start the recording right now. All right. I think we have the decorum. I think we are missing 1 or 2 people, but I know they are joining in right now. Slowly by slowly, we shall be admitting them in, and maybe when Jingo joins in, who's helping me coordinate this, I'll kickstart it off. I'll introduce myself, then I introduce what we're going to go through, and then we do this. But before that, I would want to thank each and every one of you who has taken in a little bit of your time to kind of attend my inaugural masterclass. This is the grand final, so I hope I deliver to the expectation. My name's Alex Kakande. I'm based in Bermuda. I'm into finance and investment. And someone who's unmute, can they help me mute themselves for just a moment so that we do not have background noise? See who it is. Give me a minute. Okay, apologies on that. I was trying to make sure we don't have background noise in that. My name's Alex Kakande. I'm finance, I'm investments, I'm debt. I deal with those things almost every single day because of my nature of my work, but now I'm focusing and trying to do so much from an investment advisory perspective. Okay, the people are not joining in. Oh, thank you so much, Maweje. Perfect. Perfect. So finance, investment, debt management. I hope you still, are you seeing my presentation?
No.
No.
In Africa, as an African man.
Alex, we can't see your presentation.
Okay, it's back. Sorry about that. Now you can see it, right?
Not yet.
I'm
doing
yes,
we can see it.
Oh, okay. Perfect. Perfect. So of the things which we are going to cover is what we are seeing here in a nutshell: finance, investment, debt. For the first time, actually, in the last 2, I didn't do it, but for the first time in this one, we're going to even talk about how someone can use debt, especially for those of you who want to invest in a treasury bond. Can someone help me mute, please? I kindly request that we don't have we have a good experience. Thank you.
Sorry, Alex.
All right, thank you. So of the things we're going to cover, and
sorry, Alex, I can't see the presentation on my end. I'm not sure exactly what's happening and how. Okay, now it's on. Thank you.
Perfect. Perfect. So the things we're going to cover, which is very, very important for me, is an investment strategy. I know most of us, we invest when we have the money, but sometimes when you take a step back and plan ahead, you get a better picture of what you have to do. Like I always say, we are in Christmas. Most of us right now know where we're going to spend Christmas from. Are you traveling to the village? Are you going to do this? When you have a picture, even the way you go out to achieve that is a good thing. We're going to cover what the treasury bonds and bills, to a great extent, some unit trusts, a little bit on education funds, policies, life policies. Some people have them in that particular capacity, and a little bit of debt management and how it can fall into your whole strategy. And we shall wrap it up and say, how do you make money? Because at the end of the day, if you are not, if whether you're employed or not, you're trying to better yourself and do exactly that. So for the investment strategy, there are three things which I admittedly would want anyone who, especially if you have listened to me, I talk about. For all of us, you need to have a purpose you are trying to invest for. It's a matter of, it's as simple as that. Whether you are investing to say, I'm investing to have my own house in 5 years, whether you are investing to say, I want to buy a car, whether you are investing to say for my retirement, for those of us who are parents, we say you're investing for your children, whether whatever reasons that you have it, own it up and write it somewhere and say, this is my goal, this is my purpose, this is why I'm doing A, B, C, D. Not to say that because I have the money, so either way people are investing, so let me invest. Whatever that is critical and dear to you, state it out and put it there. What this will do for you is for you to set up certain objectives and even parameters that are going to guide you on how you're going to invest. Where you're going to sit down and say, what are going to be, if I'm investing for my kids' education in 20 years from now. Can someone help me mute? I would need to get off sharing for me to see it, which distorts the experience. Thank you. When you set up the objective and it's clear to you, it will guide you on how you're going to end up investing. Case in point, if you are sitting somewhere and you say, okay, I am investing for my children, they are 5 years, they are 10 years, and you want them to, you're investing for their education. Of course, you should not invest in something that is going to give you back the money in 2 years, because what you're investing for is in 10 years, 15 years. You should be patient enough to wait it to grow. If you're investing for retirement, which is a good thing, then you should be in a position to say, hello, whatever I'm deploying my money on should be in when, if you are 35, it should be in 20 years from now. When you're investing for emergencies, it's important. Emergency means liquidity. When you need money, you must have the money. So if you're investing for liquidity, for emergencies, for healthcare, you have to put it in something that you can easily liquidate. You can't sit there and tell yourself, I'm investing for emergency, and you buy a plot of land. It makes no sense. But if you sit there and say, oh, I'm investing for my kids' retirement, for my retirement, of course, in that capacity, you can go and buy land and put on trees, because chances are the trees will take 15 years to grow. By the time they grow, your kids are 25 to access that money. 3, diversification. It's important to diversify in your portfolio, and it goes back to this position of investment purpose. When you set up your investment purpose, they can be as many as possible. They will end up guiding you on what to end up investing on. Now, it's critically important. The same way you sit back and say, okay, if I'm studying, I need to graduate with my master's in 2 years' time. If you are at university already, or you are doing adult education, like I need to finish up this course in 3 years' time, you have an objective. It's the same thing you have to set up for your investments, for your finances, because a guided coin runs better than an unguided coin. That's why if you have money and you do not have something you're trying to achieve, targeting to your mind, chances are you're going to leave that money on the bank account. And we have seen what has been happening for many of us. You can sit back and like, oh, wait a minute, the last 2 to 3 years, how much money has it been sitting on my account or my mobile money, not doing anything? Because at one point you didn't have a focus. Or if you had a focus, maybe it wasn't so defined well enough to realize what do you need to do. Maybe you said, oh, I want to buy a plot of land or to construct my family home. Then all of a sudden you get the money and say, let me put this money every single day on the account. It's on the bank account. It's not earning anything. You actually are paying money off it. The other opposite is when you sit back and redefine your strategy, you sometimes can make better informed decision as compared to if you don't. Now, the most critical point when you set up your Alex, can you mute for me? You have just joined. The other critical point, which is critically important, is when you have done that, you do the review performance. I know I have an M&E personnel on this call. What they call the M&E, they pride themselves in monitoring and evaluating everything. They create inputs, they set up timelines of outputs. Every single day, every single 6 months, they say, how far are we to achieving our goal? How far are we? You need to implant that within your system. You need to implant that into your system to say, I will tell you, for me, every 6 months, I have to be there and I say, where is my coins? How much have I achieved? Am I on target to achieve what I set out to achieve every year? And every 2 years, am I on target to achieve my long-term goals? Why? Because it's now clear. When you have that written and set out in the easiest of templates, you will kind of go hard to achieve that. Things like setting budgets, they might seem simple, but even having your mindset, let's use the simplest way, to even having your mindset that I earn 1 million per month, but in my head, I know this 1 million. If I pay off rent of 300K, I remain with 700K. If you have a budget and say 10% of this should go, those who tithe, it will tithe. 20% of this I must invest it. 20% it is transport and enjoyment. You will have a better way to direct that money than another person who has the same exact money, which is 1 million, but they do not have a targeted goal to achieve. Why? Because at that point they are thinking, okay, what do I need to do? The money comes, then they might as well just spend it the way it comes. So it's critically important. One important thing from this conversation, which I always say I kindly request, is after the call or after 2-3 days when you have settled in, sit back and say, what am I chasing my money for? Write it down. The simplest way, the way you write your names and say, what is my investment goal? I want to invest in A, but why am I investing in it? Ask yourself why. Then when you have said defined it, then you say also, what are my return objectives? It's interesting because that's interesting when we talk about the products later, you end up realizing, are you putting money in something that is giving you a 6% return, yet your target return should be 10%? Return, those are the profits percentages. We call them profit percentages. I know someone here who is running a small business, a farmer. We recently were reviewing their performance. He's on this call to learn about today, but we are doing their review performance and told him, please join in this call. And we're like, by the time we reviewed the performance, he wanted to sell his farm. By the time we reviewed the performance of the farm, it was doing way better than he had ever anticipated. How did he notice that? Asking himself certain questions, answering those questions, looking at the numbers, that it would have been a terrible idea to sell off that farm. Now we had to move forward to say, okay, what can we do with the profits of the farm is bringing in for us to channel them out? It's good to diversify and review your performance. Now, when you have set up your investment goals, and now you have set up what you're going to invest in, you have your 3-4 items. Already, most of us who are here already have even those investments. We're going to end up assessing them. How are they been performing? It's the same thing as saying you have 4 plots of land. For a moment, you want to sell off one. But the question, which one are you going to sell off? Or you want to develop one. You have to sit back and say, okay, this one I bought with the same money, but the value is not growing as much as it's growing. The other one, it's a hot cake. The other one, it's not a hot cake. The other one, it has potential to grow in rent or money. So you make a decision based off that. So it's the same thing of an assessment. So from that perspective, then we're going to talk about investments in a holistic way that addresses 2 things. What we would call the money market investments, things that are short-term in nature, but they bring in profits, or things that are easy to liquidate, or things that their profits are low. So now, why am I categorizing all of these that the profits or the return prospects are low versus capital markets investments, which are long-term in nature, profits might be much more, and you have to be patient enough to see that money growing. At any one point, if you have a question, if I finish off a unit off here and you have a question, it's okay to ask it, but I would prefer if they come in at when I finish off, let's say money market funds, then you ask the questions around that. So for money market funds, the easiest and best way to invest right now is the unit trusts. We have 6 of them right now in Uganda. It's the best way. It's a question of right now to say, if you do not have a unit trust, you are missing out. If you do not have a unit trust right now, you are missing out. One, the money, unit trusts these days are like bank accounts. Actually, they are literally bank accounts. If right now you bank with the Stanbic Bank, the only money that should be on your Stanbic Bank account should be the bare minimum of your expenses. Yeah, you can type the questions in the what, that's good. The minimum you need should be for your expenses. Even if your money is, you can invest in the Stanbic Unit Trust. Why? When you need your money in between 4 to 6 hours, it's on your account. That even if you have an emergency, they can give you that money in 6 hours. So why would you leave money on a Stanbic account when it's going to earn maybe less than 1%? Yet in the Stanbic interest, you can earn a 10, 11%. If you bank with Standard Chartered Bank, it means Sanlam turnaround time with Standard Chartered Bank is less than 6 hours. UAP, less than 6 hours, right? ICEA, they deal with KCB, less than 6 hours. So sometimes even the unit trust you end up choosing might be which unit trust, what is their bank, their custodian bank. If you are with their custodian bank, you get that money in less than 6 hours. Actually, most times even 4 hours. Godfrey, can you try to disconnect and connect, because I'm speaking and I believe other people are hearing me. Then the other money market product is a treasury bill. Now, I put it here, but I would never, now, this one you can say, I can't say it. I would never recommend you investing in treasury bills. And it's a simple mathematics. Here, I'm going to switch to an Excel. Yep. So I'm choosing it an Excel to show you treasury bills. It's easy to know about them, but there is a reason I actually don't even write about them, why they do not make money for a retail investor. So now, this is a treasury bill. They sell them at a discount, which means if its face value is 1 million, the cost of it will be, let's say, 880. Let me make it bigger such that you can see what I'm trying to do and why I would never recommend you buying a treasury bill. And I would say you'd rather put that money in a unit trust. So the first value is what the money you're going to get when the treasury bill expires, let's say in 1 year. The cost is 880 is what you're going to invest in, right? So what ends up happening is, it means the profits you're going to make off it is 120. Now 120 is literally a return of, this is the money you invested, in 13.64. So which is a good return. But this is, let me put it here. This is the gross yield. So it's a growth. If someone tells you, oh, I made a 13% profit, then you'd be happy because you're like, oh, that's a lot of money in 1 year. The problem is it has a withholding tax of 20%, which means, okay, I'm going to explain that. Thank you so much. Let me finish off. Which means the net yield or net profit is times 80%. So that means the actual profit you have made of your investment is just 10.91. Now, let me explain what these things mean. Face value, we're going to talk about it more later. Face value is the bond in the treasury bill language. That's the amount they are going to give you back when the treasury bill expires. So we buy bills for a year. It's either 3 months, 6 months, or 1 year. So let's say if the face value of that bill is 1 million, it means they will give you back 1 million, but in a gross term, that's critical. The cost is the amount you pay, the real cash you're going to buy it. So that means you buy it at a discount, which is your profit of 120, right? But the profits you're going to make, it attracts withholding tax of 20%. So the actual profit is 10.91%. Then if you invested 880, that's after 1 year. If you invested that in, I think I have this document. If you invested that money, that later. Give me a minute. Okay, I will need that later. If you come and went and bought a unit trust, any unit trust, whether UAP, Sanlam, Britam, Zeno, they offer at a minimum 11%. If you went and put 880 in the unit trust for 1 year, I need to add 1 month here. For 1 year, the profits you're going to make in a unit trust are this, a total, because for them, they state it after tax. So you're going to make 96,800 at 11%. But right now, some unit trusts even offer as high as 11.5%. So if by any chance they give you a 11.5%, you make a profit over 100K off this money. When you compare that with what you make in a treasury bond, in a treasury bill, is well less than what you'd make in a unit trust. Yet in a treasury bill, it's there for 1 year. You have to wait for 1 year, or if you have to sell it on the market, you might sell it at a discount. Yet for unit trust, you can access your money whenever you want to access it. So, whereas I still put it there and I want people to learn about treasury bill, if you ever go to a bank or to people who are now getting interested in selling treasuries, you tell them, and they tell you, okay, the Bank of Uganda is selling a treasury bill. You say, I'm not interested. There is an email I wrote on Thursday and I said there is no auction for treasury bond this month. And someone reached out to me like, but yet my bank is telling me there is an auction next week. That auction is for treasury bills. Why I do not kind of say people should buy treasury bills is for that exact reason. Because you have an alternative that can make you that money and much more money with ease of access of your money than a treasury bill. It's not treasury bond, it's just a treasury bill. If you have a question on that, I'll come back to that. So that's why you never hear me talk about treasury bills or recommending people to buy them. It's because the money markets, the unit trust will make you a little bit more money with ease of access to your funds than a treasury bill. Then for money, another item of the money market is the life and education policies. Now, these are long-term, but I've categorized them into money market fund for one reason. From an investment perspective, the return they offer is so limited that it is not an investment. If any one of you has a life policy here, or either with a Prudential, with UAP or the Mutual, with Jubilee, when you look at the money you're giving them those every single year, every single month for the period of 5 years or 10 years, the amount they assure you, what we call sum assured, is too little to call it an investment. But it's why? Because these policies are insurance policies. When an insurance policy is there to hedge against a specific risk, you are 45, you believe you might know something might, not you believe it's, these are risks of life we live in. That the risk of, if you right now you are to get impaired or injured and you can't work, you might not afford to educate your kids. you do not have enough assets, then you buy an education policy that in case it happens, they have something to fall back onto. In the global world, in the Western world, life policies is one way people pass on wealth to another generation. So they believe, okay, I'm going to live for the next 40 years, but chances are I might not save so much. So let me buy a life policy that in case I die of natural, of certain, or specific causes, my family might be paid a life policy of 2 million. But you have to contribute over a longer period of time. But even then, people are telling people now, you only do that if you don't know how to invest that money. Because if you know how to reinvest that money, you can make more money than that life policy. The only benefit of it is if the risks materialize. It's the same way as buying a medical policy. Now, if you have ever thought of buying one, or if you have one, you should not evaluate these policies based on the profits they give. You should evaluate them on the risk they are protecting you against. Now, if you are, I have a client of mine who recently we're trying to cancel them. And I'll give you an experience of why are we trying to cancel the 2 education policies. I asked them a very simple question, which you can ask yourself is, if you is around 42, and the question was simple. If something is to happen to you right now and you are to pass on, will your kids struggle to study? He's like, no. I'm like, why? I've established certain apartment units that can educate them if no one sells them and no one misuses them, of which if my wife is still there, I trust that he will not misuse them. My kids will not struggle to find school fees no matter what. Then I'm like, okay, anything more? He's like, my wife also is fully employed. Then I'm like, then why did you buy them? Because to you, the risk of education is not a risk. It's a risk that if for any of us, if something happens to us, the kids might not study. But in your circumstances, it's not a risk. It's too remote to materialize because you have already established parameters that can bring in income that will educate them for the next 20 years. Then you ask, why did you buy them? It's because someone sold them to me as the next big thing in 2020, 2021. And you remember people after the COVID, people said, if you don't have this, it was the holy grail of everyone buying a life policy. And now I'm like, no, in your circumstances, this doesn't make sense. So let's find a way to cancel them. And you channel that money to the real investments you're trying to do that grows the portfolio you're building for your kids. And that is a genuine concern, because if that's not a risk, do not go into them. I'll pause on a minute for those 3 items: unit trusts, treasury bills, and policies, before I move on, if someone has any question. Or if you type it in the chat, I can see the chat, and I'm going to be reading through it. Okay, no question for now. We move. So those, okay, Jerome has a question. Please comment on the fees charged in a unit trust. Okay. Now, unit trusts charge, I think all of them charge between 1.5 to 2% of management fees. Anyone who is going to make you money will charge you something. Or anyone who's going to offer you service will always charge you something. How I want to always analyze or interpret it for people, and we might do a comparative later. Maweje, help me do your thing. We might end up doing a comparative later, is in such a way that what is the net return after tax, after management fees? What profits do they give you after management fees? When a unit trust says it is giving you 11% yield or return or profits, that number is after management fees. All of them. Actually, the only one, I know it's only one which states its profits in gross yield. I think it's Zeno. Zeno is on which state sitting like 15 because of their mode of direct saving. But even then, when you take off their management fees, you still range within their 12-13%. So all unit trust, when I talk about I say in a unit trust, you're going to get 11%, 11.5%. It's purely a minimum after management fees. So whether they're going to charge you 3%, for as long as 11.5% makes you more money, you are good to go, you know. Colin, is it better to have one unit trust or many? And now I would say it's better to have more than one. I personally have 4. But the question is, why do I have 4? One, by me having more than one, I can access information as I need. They always want to give you the information if you also give them money. But also, unit trusts do not every single month or in a 1 year, they don't make the same money. If right now you wake up and give all of them 1 million, after 1 year, there will be a differentiator of who has given you more money. So what I always tell people is have more than one, whichever every single month, and start with the same exact amount of money for them. Whichever every single month gives you more money, that's when you should be starting to give, because it means it's making more money. It's then you should be starting to give more money. But all of them on average, they offer the same rate. 2, have more than one because of the services they offer, the convenience. If I need quick money and I want it to be wired to Standard Chartered, UAP or Britam or Sanlam, they're quick in that. If I'm in Stanbic, that's where I want my money to go quickly. Stanbic Unit Trust is good. If it's KCB, ICEA. Zeno on mobile phone, you can easily withdraw your money. That convenience also kind of determines which unit trust to have. Michelle is asking, I have a life policy 7 years with pre-education saving, one with Prudential, and now wondering after your advice whether I should just cancel it. It's for 14 years. It's an education policy. I would have to ask a few questions to understand, to guide you if you should cancel it or not. But you have to sit back and assess, what are they risking? What are they risking me from? Is it a risk that I should continue on? Right? If it's an education policy, it means they are insuring you against loss of life for them to educate your kids. The question is that why you went there, to protect you against a risk, or you thought it was an investment? So I would need more facts on it, but you can take that offline and I kind of look at your paperwork after this, and then we can look at it and I say how best you should do it. But there is that position where you have to think through and say, it's for 7 years. Even if you have to think about it right now, if you have to cancel it right now, they'll be like, oh no, we are not giving you back all the money. Like, but wait a minute, why aren't you giving me back all my money? That's when you realize it was not an investment, because in an investment, so that one we can take it offline, but there are chances are you have to think through and be like, yes, this is it. Zeno is the odd man out in all unit trusts. Highly technological, very ambitious young people who are running it, very critical. They are doing it goal. They are goal-based in kind of saving and investments. It's easy to onboard people and everything. When you notice, there are 6 unit trusts. Someone was asked about them. There is Old Mutual. It's backed by an insurance company. It's the biggest. There is ICEA. ICEA is the second biggest, backed by an insurance company. There is Sanlam, is the third biggest, one of my favorite right now. They are backed by an insurance company. There is Britam, amazing customer care. Amazing customer care. They are backed by an insurance. There is Stanbic Unit Trust, backed by the biggest bank. Zeno is the odd man out because for them, they are backed by their investment knowledge and their investment grounding. So it's a good one. It's a good one. Yes, I recommend. Like you, it's okay to have even if you have 5 or 6 of them. Zeno, you can right now, if you have a phone, I don't know, I can't remember their prompts. If you have your mobile money, if you are on MTN, you can sign up on Zeno right now and start depositing money today. And Monday, they have everything running. And by Tuesday, everything is doing. And I know even UAP now has that prompt. But that's like they have enabled the technology. The Zeno, they are frontiers there because you can see they are not so much into the grounded backup of the big insurance of banking. So for them, it kind of automatically feeds into that. And is here. Someone, how did Sanlam deliver return of 12.3? I believe. Yes, Sanlam is doing extremely good. Sanlam, and I'm not going to talk about why they are offering a 12 versus a 11 versus a 13. I love all these companies. They are amazing. I'm going to do a report on them at their end on why they are doing and what makes them tick. So, but Sanlam, yes, is doing a really good job. Its return every single month is really good. So you might want to think about them if you have never what. Diana is asking, what if one of offering a higher investment now offers less in the future? That's why you have to monitor, Diana. That's why you have to monitor their performance. They might give you a 13 now, then they go to a 9 next month. Then you sweep some of that money to where you are getting a little bit more money. It's that good. You should not be comfortable in a way that makes them to kind of make you feel like, oh, it's your money, let them compete for your money. It's like you going to the market and say, I came to buy tomatoes and you gave me 10 tomatoes for 10K. The other one gave me 12. Next time when I'm coming, I'm going to the other person. They should compete. And that competitiveness will force them to be innovative, will force them to lower management fees, will force them to know that the customer is the winner in all of this. The last question on unit trust, and I move on to other products. I don't want to dwell so much on it. Do we have any interests where we can invest in dollars, Damali? Yes. UAP has a dollar unit trust. Britam has a dollar unit trust, and Sanlam. They have moved over ahead of the pack. All of them, I would recommend them. All of them. They are offering around 5 to 6% return in the dollar trust, and that protects you against. Vanessa, which one would you recommend? If they ever find out that I answer this question, they might eat me up. From a political answer, I recommend all of them. I have 4 of them. Potentially by the end of next year, I'll have all the 6. They serve so many things that I do it really well. But even for me, because I'm an investment person, I believe in diversification. Diversification sometimes means in companies, I might be buying the same product, but let me buy it in 6 people. That way I can monitor the performance. For me, I do. After they send monthly reports, I sit down and I say, company A has brought in 10%, company B 11, company C 12. Let me put my money into company C. Next month, another like that. It's not sentimental, it's pure investment decision. Is this information applicable to Uganda? I believe if you're from Uganda, it's from Uganda. If you are not in Uganda right now, I don't know who's the unknown user. They didn't put the name. If you're not in Uganda right now, I would have to ask which country you are in for me to answer you that, because money market funds are everywhere. Money market funds are in every single country. The companies I'm starting about, they're in Uganda. Freda, thoughts on NSSF? Oh, you're in UK. In UK, if you are investing back in Uganda, thank you so much. Oh, I know who this is. If you are investing back in Uganda, these are specific for Uganda. If you're trying to invest in UK and targeting the money market funds in UK, they are called mutual funds. And I will talk about a little bit more on the exchange traded funds. They are mutual funds, and they're so much backed by pension companies. Now, those, you have to be very careful not to sign up for pension products. You have to look for a mutual fund which offers what they call the liquid mutual funds, that you can withdraw your money anytime you want. So they are available there, right? But we can take this offline so that I don't go into it for 30 people who not benefiting it, and they can advise you on which one to take up on. But they are called mutual funds. They are there in UK. NSSF Smart Life. Yes, that one I wouldn't call it. I wouldn't call it a unit trust, but it offers unit trust products. The only difference is in the NSSF Smart Life is that you have to lock in that money for 1 year. If you sit down or you know someone who you have tried to convince to join money market funds and they have already said, I do not trust those brands, for God's sake, now they should trust NSSF. But if NSSF, you also don't trust it, these are the Stanbic Bank. It's the same. We are yet to see what NSSF returns are going to be on their Smart Life, but we hope they're going to be as competitive as possible. The question of dollar, Shakul, remind me at the end and I come back to it. I don't want to drive so much into these. Some of these are going to benchmark, especially this one, I'm going to benchmark on it later. So remind me about it in a minute, in like 30 minutes from now. Now let's go to capital markets. I know questions are going to come here. We're going to go past 2 hours. I want you to have an amazing experience in this conversation. So keep the questions coming in. Maclean, 100K, that's good. You can start with however much money you want. But 100K is a good one, and then you keep topping up. When it comes to capital markets, okay, maybe let me finish off on that one, Maclean. For unit trusts, it's about compounding, and they compound for you directly. So let's assume for unit trust you have 11%. It's offering, like, for example, UAP has been offering around 11% minimum, but in this latest month is hedging towards 12%. ICA 11, 12. I think all of them are a minimum 11%. So let's assume you sit somewhere and say, I have a savings of 100K per month. And that's all you have. And you start in January 2025. And you somehow they maintain the 11.5% minimum. And they do that for the next, you do that for the next 7 years. It will grow to 12 million. If right now you have a house manager, I look at unit trust as something that is going to enable our underserved clients to learn how to save and invest. If you have a house manager right now and you have been with them for 5 years or 2 years, and you want them to learn also about these amazing products, do not tell them about anything. Tell them about unit trust. Let them deposit a 50K or 100K. And even you can even say, whatever you deposit, I will always add something for you. And you consistently say, if you do it, and you show it to them and say, if you do it for 5-7 years, after 7 years, you have 12 million to go and buy a plot of land back in your village, an acre of land, right? Now, you are offering them a service that they are competent. We're in December. We know when you have a maid, after December, when they go back to the village, you start praying that they are coming back to you. They are not diverted somewhere. This is an incentive where you can say like, okay, let me add value to you that you look back and you want to come back to me because maybe what I'm offering to you, the next person will not offer it to you. And you'll forever be like, this is my boss I want to work for. You are upskilling them. And doing that, you're like 100K, even if it's 50K, Now when we do 50K, after 7 years, it's going to be 6 million. But you're contributing 50K. For God's sake, that's more money. If you have more money and you say, I can contribute 500K, per month. After 7 years, you are over 60 million and you're making more money per month than the money you're contributing. If you have more money, you have targets and you say, I'm doing 1 million, then you have a chance on hitting 100 million in 7 years and making more money than the money you're contributing. But the question is, how much money are you leaving on the table by contributing 1 million in a unit trust? Some of you have 50 million, 30 million in unit trust. So which brings us back to capital products. Fixed deposits by so many different banks. Fixed deposits became popular in the early 2010s there. People learning that I can give a bank money and they assure me 10%, 11% for the next 3 years, but I do not need to touch that money. Right now, they are offering even 13% if you negotiate very well, but you must leave that money in there. It's a recommendable product as part of your diversification. If you sit back and say, apologies, a little bit of choked. If you sit back and say, for the next 3 years, I don't need this money. You have, let's say, 50 million. You are in the diaspora, my friend in the UK. You say, I have 50 million. I don't need it in the next 3 years. But I do not want to put it in unit trust because it might give me 11%. Or I don't want to go to other products. I don't want to invest it when I'm not in Uganda. Put it in a fixed deposit. Negotiate and tell them I need a 13% assured after tax, not before tax. It will work. A fixed deposit that long, 3-4 years, will beat a unit trust. It will beat a treasury bills. Treasury bills are the lowest ladder. It will beat a life education policy in the returns. Then we go to treasury bonds. I'm going to come back to the treasury bonds later. We got rentals or real estate. Real estate is a long-term investment. I write about them in so many ways, and people think I don't like real estate. Of course, somehow a little bit, the comparative real estate is sometimes hard to understand. But the right real estate investment, long-term will make you money. Whether through when you have just bought plots of land and keep them for a long time. Leonard, I'm going to come back to the compounding. Thank you. Whether you have bought real estate, land and keep it, or even when you construct certain rentals in the right place. The problem is we are driven by the money we have to make the decision. So, for example, the construction cost in Ntinda or in Chira is the same construction cost in Wakiso. The difference is the land prices. So if it's going to cost you 300 million to put up 5 units in Wakiso, excluding land, it is going to cost you close to the same money in Chira. Yet in Chira, you're going to get almost double the money in rental income than in Wakiso. But you find someone spending 100 million constructing rentals in Wakiso. Not to say you shouldn't construct it, but if you know better, you shouldn't. If you know better, because the money, the return it's going to give you is 6% return. You might as well go put that money in a unit trust. You will make more money. I'm talking about rentals for renting out, not your house. For your house, you want to go where it's cheaper. But you also have to consider driving and everything. You know? Think about buying property land. You might buy, someone might tell you and say, come to Nakwero. The plot of land is 50 million, 50 by 100. Another one tells you, come to Namulanda. The plot of land is 70. But then someone tells you, but wait a minute. Namulanda right now, they're trying to do some skipping and everything. You might buy it at 70. In 2 years, it's at 100. You are better off buying where you know the value of growth is much faster and much better than you going and buying a plot of land in Kachiri. I bought land in Kachiri in 2016. It was at, say, 7 million. I thought I had got a deal because it was cheap. Right now, you can look for someone giving you just 20 million. No one is willing to give it to you. But if I had put that 7 million in my treasury bond, then I would be way far. And I haven't even added on the cost of making sure the brokers, whatever. No. So that sometimes just because it's cheap to buy a product doesn't mean it is going to make you money. You have to assess the return. It goes back to the investment strategy we have. And there is this also notion, and I know I have Mr. Paul here. He can easily relate, or people who are above 45. But land grows, of course it grows. Someone will tell you, I bought that plot of land at 3 million. When? In 2000. Then they tell you, in 2024, I sold it recently at 40 million. Oh my God, yes. How many years? 25 years you have spent with that. Can you look at what that 3 million would have done? Alternatively, people think treasury bonds are new. No, they were there. They started offering treasury bonds in Uganda, treasury bills in 1969, treasury bonds in 1994. In 2003, treasury bonds were offering a return of 27%. 27%. That if you bought your land at, let's say 15, let me use easy money, let's say 15 million in 2000, let me even take it back to 2000. So I'm going to do a comparative to understand where we are. Yeah, we're in 2024. Okay, Anne is back. So, Anne, help me mute. I don't have that echo. Thank you. Let's assume someone, when the people talk about comparative investment, that's why it's important to contextualize and assess performance. There is an echo. I'm not so sure who is not muted, and I don't want to go into check. Thank you. Let's assume someone who told you, oh, wait a minute. I bought this plot of this half an acre at 15 million in 2000. Well, that was an investment. Especially, by the way, land grows in value. I recommend it. But let's put it into context. So if land has been growing at an average of 12%, even if let me give it 12%, it means if you bought it at 2000 in 2000, right now you can get someone giving you 200 million, and I assure you, you would have made a lot of money. And this is a story we have had a million times. A million times. I bought this plot of land in early 2000 at 20 million. Now I'm selling it. If I don't have 300 million, I'm not giving it to you. Amazing. Now, the context is here. In the treasury bonds, because to compare like with like, you have to put that into perspective. So, okay, let me do it in a different way because I'll need that tab. I don't want it to move away. Bonds in the treasury, in bonds in 2000, because at that time we were entering the risk, which was so high, they were offering a 27%. So anyone who bought a treasury bond in 2000, actually up to 2008, 2009, a minimum return they were getting was around 19 to 20%. So let me not even use 27. Let me use 19. So if someone bought 15 million of bonds, so we have two people or two brothers, one went into bought land, perfect investment. One came into bonds. They kind of had an idea. They took the risk. They went into bonds. And they got their 19% of a 15-year bond, which locked them from 2000 to 2015. And they kept on compounding. I'm going to talk about compounding, what it works. Right now, they would be in $1 billion, close to $1 billion. Now, who is making more money? Same period, different investments. So that context alone is why we have to tell people, think what is making money. But let's think about it right now in the context of recent days. Land right now, most people who are invested in land, they will tell you there is a down cycle. Down cycle means prices are not growing as fast as they are growing, or even selling is not quick to sell. So I'll reduce this return. I'll bring this to 2000. Let me say to 2020, 2021. Going forward, I'll reduce this to, yeah, Leona, that's where I'm coming. So I'll reduce this to buy a plot of land, let's say at 35 million, and I'll reduce the increment to 8%. I will come do the same for the bond, and I will also do a 35 million. But now I cannot use 19%. Right now, bonds are offering a minimum 14%. So then, for the person of the land, if they buy it at 35 million and it maintains an 8 to, even if I give it 10%, that land will grow from 35 for the next 25 years, it will go maybe to 400 million. But you can see if they bought it in 2020, where we are in 2025, that land would be at around 62 million. And that's a fair assessment. A plot of land bought at 35 in 2020, right now, if you get someone giving you 60 million, you are happy, right? Yet the bonds, on the other hand, at 35 million, you have a chance for them to grow up to 900 million. But if you bought it at 35 million, by the end of 2025, you're at around 76. So I'm better off than you. Does it make land worse? No. But you have to assess those two positions and you make a decision based on that. Now, I've started entering into bonds, which wasn't the case. Let me first finish off these other things and I come back to the treasury bonds and then we drive it for the next 1 hour plus. ETFs, for my friend who is in UK, it's a common investment. Exchange traded funds, another form of a unit trust, but for them, they are mostly investing in stocks. They are more in the global developed worlds. So instead of you going and buying stocks that you do not understand yourself, you just buy ETFs and the ETFs will go and buy stocks on your behalf. Like they invest that money, they collect, let's say 10 people here, they give me money, I go buy an ETF, stocks, a collection of them, then the 10 people just buy in my funds. It's common. In Uganda, we have one that is growing, that's coming up. I've written about, if you read my articles, I've written about it. It's called Gold Catch. It's it's based in Uganda. It's fully licensed. I've spent 6 months doing my research on them. They're somehow doing some good work. They invest in global stocks, but you buy their ETF. They are dollar investments. So for anyone who wants to invest in them, that's the one which I would recommend, the ETFs in Uganda. If you have access to global markets, ETFs are the best way to kind of invest in stocks. Instead of you going and you do not know whether you should buy Nvidia or Tesla or Amazon or the coming up, whatever, ETFs are better. ETFs are in such a way that you can easily sit there and say, okay, I want to invest in Asia. Let's come to something like that. Okay, come on. ETFs are something, it's interesting. Opening up my trading platform where I track investments. I want to show you something. So you might sit there and you're like, okay, I have more money. I want to do, I want to diversify. I'm told there is gold mine of money-making machines in the Asian markets, which it is, by the way. But you don't know where to, you cannot just go and buy Malaysia stocks or buy Singapore, South Korea. No. But you are in UK, you have access to US, you have access to, I think someone from Sweden. Then all you have to do, and a friend of mine who is from West Africa, all you have to do is to say, let me look for an ETF that targets stocks there. Then you come and you say, I share. right? You can see the iShare. iShare is one of the core ETF of BlackRock. BlackRock is it's the biggest asset manager. So when you put the iShare, they tell you, do you want the one which targets 500, the S&P 500, the one which targets corporate bonds and bonds which are investment grade? Do you want the Russell 200? This one targets mostly upcoming entities. Do you want the high yield corporate bonds, but they might be low graded bonds like Ugandan bonds? Do you want emerging markets? So let's assume we click emerging markets. Then you come and do what? How it has been performing. Where is chart? Chart is here. Right? Okay, it's disturbing. Okay, here. Then you look at it and you see it comes up, down, comes up, kind of like. So instead of you investing directly in the emerging markets, which Uganda is considered, no, Uganda is not an emerging market. Kenya is considered an emerging market. Then you just come and buy an ETF of that. But you have to have understood what ETF you're trying to buy in. Some of the people, all they do is they say, okay, I don't understand these things. I'll just come buy the 500. And right now, the 500 has been making money. It's a money-making machine. You can see it's growing by the day. This is in the last 3 years. It was down in 2002 August when every stock was going down. Ever since, it has been going up. So for those of you who have access to these markets, well and good. You should go for it. Someone has put in a question. I'm going to come back to those questions later. Stocks and equities, highly recommended. But depending on where you are. In Uganda, we do not have so many. In Uganda, we don't have so many stocks that are making money. I think we have Stanbic, highly recommended. MTN, highly recommended. Bank of Baroda, highly recommended. Umeme, to some extent, people are willing to take a risk on Umeme. They know government is paying them back. The concession is ending in March, and there might be a payment by June. And someone is willing to say, I can buy the stock now and be willing to get some good money when government pays up. It's a risk to take. But yes, Umeme has been a good stock in the last few years on the Ugandan Stock Exchange. DFCU, it has been going down, but it's coming back. All the guidance when you are buying stocks, especially in like Uganda, buy stocks that are paying a dividend. Do not go buy New Vision, because New Vision, its share price is at 1 shilling per share. You will look for the return on that money. You will wait till kingdom come. But buy the big global companies that you know MTN is paying a dividend, it's making a profit, it's expanding, and make money out of it. So before I go into fully treasury bonds, which are going to take us into so many questions from experience, let me first answer some of these questions. How do we use past information such as that want to make a future decision? Past information is not past. Let me call it this way: in investment, what we say, past performance is not a guarantee for the future performance, but you can track and see. If you have data for the last 5 years, there is limited chances that all of a sudden things are going to change holistically in every information. If a unit trust has been giving you 10%, I don't think it's about to come and start giving you 13 or go to 7. If land has been growing at 7%, it's not about to grow at 20%, and it's not about to drop to 4%. Rental income, rental yield is if they're at 6%. We know a property right now which is worth 200 million. The maximum money it can bring you in a year is 20 million. It's not about to bring you 40. Maybe in 5 years it might, or 10 years, but it's gradual. So you have to look at past performance. Yes. Which has more interest, exchange traded funds or unit trust? For Ugandan context, stay in a unit trust. and diversify if you have some money, more money, into ETFs. We only have one ETF in Uganda. I can kind of say that is it. It's, let me, because we are here, it might be also paramount to do that. Sorry, why is this? These websites have been down in the last few weeks. So I always tell people, when you are to invest in something, at least for the starting position, make sure it's licensed and it's regulated, because it means there is certain things they must add there too. It's this one here. And I've written so far I've written 2 articles about it. It's this one, Gold Catch Uganda, right? And what they do. So you can go on their website and read about them. I'm not going to tell you get all your money and put it into it, but it's something you can start looking and paying attention to and how to take advantage of it. What if I bought condominiums and turned them into rentals? Liz, did you buy them? Are you asking it from a rhetorical question, or are you asking it from me? I should assess condominiums. I would want an answer for you, and I answer you in a better way. Otherwise, if it's from rhetorical question, let's take a step back. We have data here we can use. It's always good to look at the data, which we can make then better informed decision. Now that we are here, let's look at it this way. This one, they tend sometimes to publish data. This is a bedroom. This is for staying in, right? So let's look at this for just a. I'm assuming you are seeing a Twitter page, right? Someone should give me a nod at least.
Yes.
Perfect. So someone advertises these 4 units and they are saying Chanja Kungu, Rofte, beautiful, whatever, at 420 million. That means your investment is 420. If you add on broker fees and everything, it's 450 and legal transaction. Or you can say this price is highly, you might bring it down to whatever, but let's use 420. Before you buy them, you have to ask yourself, how much rent am I going to make from these units? You look at them and say, this is in Chanja. That in Chanja is such a unit where it has a parking space. They are not telling us if it's 2 bedroom or 1 bedroom. Let's say, for the greatest of effort, 1 million, but I'm assuming this might be like around 800K. So if there are 4 units, coming back to our Excel here. No, where is it? Let me use this. If there are 4 units, and you're going to be 800,000, right? So that means you're going to be making, is that 80 million? Of course. You're going to be making 3.2 million per month or a year, 38. And that is assuming full occupancy, but in Chanja, you always have full occupancy. Then you come and say, how much of this I have to pay tax? These days, it's important to be on the right side of the tax man. I would always recommend it. So of that, you have to pay 12% tax. That's tax. Then you say, maybe you are going to put their security and whatever cost, other costs, let's put them at 5%, depending. So times 5%. So these are the costs. So that means your net income is 31 million. So the question is, if your purchase cost was 400 million, let me not use 400, let me use 400 million for the sake of, okay, that's, so that means your net yield per year is 8%. You ask yourself, is this a good investment decision? A net yield of 8%. Sometimes it can be yes, in case you are too much exposed in other investments. But if you are, this is the first purchase, this is the money you have, this is all you have, I'll tell you, do not. But maybe this is one example. Let's look at one more. I want to look for where they are talking about. Let's use like this one, because they are even already stated the rental income per month. So they are saying 1.2 billion. That's the price. And they are saying the income is 10 per they're giving us to us as 10.05. So that means you're making 126 million, tax 15%, 12%, other cost 6 million. So your net income is 104. You are deploying 1.2 billion to get a 9%. Is it a worthy investment? Then you have to consider another element when it comes to your estate. What we would call the capital gains, of which sometimes in apartments, it's the capital loss, not necessarily capital gains. That if you buy these apartments at 1.2, you have to study what is happening in Kenya at 1.2 billion. For the next 10 years, will they be worth 1.2 billion, 1.4 billion, 2 billion, or 5 billion? Like, you have to assess the growth pattern of that. So before you sign it off and say, let me go buy that kind of property, these kind of properties, you have to assess, you have to look at it from that perspective. I thought I would see the condominiums in, I thought they had posted one recently, one in like Garuga. But let me use the numbers in Garuga, I know them. In Garuga, they are selling those condominiums at, let's say, at a cheap one at $95 times, they say 37. So you're going to buy one condominium at 350. So it's one unit. Most of those are being rented out at 1.2, 1.5 million per month. But let's assume you get someone giving you 1.5 million per month. So you're getting someone giving you 18 million. Take off tax and everything, you're getting a 4% yield. Absolute no purchase. If I was going to say absolute nonsense, but I'm like, none. The only way you should buy, if this property is $95,000, that means you should first assess and say, how much money am I going to get here? Rental income. If somehow this one you can make sure you get out a 2.5 million, maybe. If somehow you can squeeze out a 3.5 million, then buy. But if you assess that property cannot give you 3.5, yet you're going to spend 95 grand on it, then don't buy it. It's a terrible, terrible, terrible investment. Because they are fetching just as low as 2.5, 1.5, but even if I say 2.5, it's just 7. Yet you have deployed 350 million in that condominium that you don't even have a title for, you know? So I hope that answers your question. If you have borrowed some of the money, what's the money story? If you have borrowed some of the money to make that decision, borrowed. Okay, now that brings in an element which I'm going to talk about in the bond market for someone to make a decision on that, the bond element. Welcome, Pamela. You have joined in at the right time when you're about to start the Treasury bonds, which I know most people are interested in. Treasury bonds, where should I start from? Treasury bonds are you lending money to the government for a period of time. The simplest way to put it. Yet right now, I would say for most of us who are employed, even those who are in certain businesses, it has the potential to make us extreme amount of money depending on how much you're putting in. And I'm saying this cautiously because I think people are starting to look at it as if we are driving people to the ground. Treasury bonds right now in Uganda, the long-term treasury bonds, the 10-year, 15, 20-year treasury bonds, offer a minimum yield of 'Give me that. There is a document of mine I'm looking for, but I don't see it. See, treasury bonds right now, they offer a minimum return of 14% after tax. I'm looking for this document to bring out something. This bond was issued in 2015. Of the bonds right now that are still on the market, it's the oldest. Bring it up to show you something. Give it a minute. Yeah, it comes. At the time it was issued out at an interest rate of 20%. To put that into context, because I want you to understand the concept of, I want to go slow but sure when it comes to treasury bonds, because I know that's where majority of us are interested in. So it was to mature in 2030. Let me use something different. May 30. Yeah. Its coupon is 17.5. So let's take a step back. Walk with me. Take a step back to 2015. Sometimes to see how much money you have lost if you didn't join in the back then. Even me, I was not in treasury bonds back then by now. So let's feel bad together. This takes me back to what? 2016. I needed to go back to 2015. Yeah. In 2015, when it came out, towards the election period, the risk of that time and the desire, do you remember the go forward period? Yes, I'm going to explain them, Shakul. I think time to explain them. But I need to first drive a point. The election period of 2015, it was so momentous. The government was broke, needed money, funders cut off somehow. I actually, at that time, even me by then, I was not even in finance. I was in M&E, traversing the country before funding was cut off in 2016 to figure out what do I need to do with my life because NGO world was becoming a little bit risky. This bond between 2015 to 2016, it had an interest rate of around 21. Now I'm coming to it. Now let me explain these terms. A coupon, the coupon maturity period is when the bond matures, when you get the investment amount. In this case, 2030. A coupon is what determines your cash flows. This one, let me highlight them in a particular color, like this one. First way to get excited a little bit. this one and this one. So let me talk about this in a different. The nominal value is the face value. You remember the face value of the treasury bill is the value of the money they will give you back when the bond matures. The coupon rate is what determines the coupon income you get every 6 months, and it's computed on the nominal. But I'm never worried. This is the amount you want to target. Never worry about the coupon. The actual holy grail is this figure here, which, okay, not yellow. Okay, that color doesn't blend in very well. That's ugly. Okay, yellow. It blends in well. This is what you have to pay attention to. It carries two names. It carries either yield to maturity, which is the same as saying interest rate. Which means interest rate. Why? That is what determines the actual profits you make. Because the higher the interest rate, either you're going to get the bond at a cheap discount. That means you're going to pay less money, or you're going to get a higher profit every single time they're paying money. Now, think about it this way. Because the coupon, I can take it this way. Because the coupon is 17.5, it means for every 6 months, you are going to get half of that. Which will come down here. That means this person who invested in this bond, they made every 6 months they have been getting 8.5 million, and they are going to get that. Okay, something is hidden here because I don't want to. Okay, now this is more realistic. They have been making 8.5 million for the last, we are here, for the last 9 years. They have so far made over 154 million after tax. And they still have more to make, 85 million, before they are given back their money. Yet, this bond, because the interest rate was at 21%, they got it at a discount. They paid less money, 91 million, to get a bond of 109. So they got a discount of 20 million right away. Let's assume if they had 100 million to invest straight as cash at that time, they would have got a bond of around 119 million, and they would be making money of 9.3 million. Extremely profitable. It means that bond alone, even if they have not been compounding, that bond alone is going to make them close to 390 million by just deploying 100 million. They have not yet compounded. They have been taking that money and eating it. That is 10 years ago. Where are we? I bring you to the bond that was sold last week. Last week but one. Last week. So let's take it back, minus 10. Yeah, actually it is 9 now. It is last week. That bond has a coupon of 15%. I've said this one, don't worry about it. Always worry about the interest rate. It came out at 17.5, and someone who is asking about as we come closer to the election. Let me use a little money. Sometimes people say I use a lot of big money. So let's use 30. The person who bought that bond, who participated and invested 30 million, they bought a coupon of 30 million. They paid just 27 million. Yet in just 30 days from now, they're going to start earning money. There is something hidden here. So the actual profit, the actual bond, they bought it at 86 million. No, at 86, which is at, they got a discount of 14%. What that means is every time interest rates go up, it means all bonds come at a discount. Every time you want, if you're an investor in bonds, and we're going to talk about the risks for now, I'm trying to talk about the numbers. Every time you want to buy a bond, you want to make this number. Even if you go to the bank and you're buying it on the secondary market. Yeah, cool. Okay. Let me take a step back. When you're buying an interest rate, when you're buying treasury bonds, you want to make sure this number is as high as possible. It's the holy grail of treasury bond investments. The higher it gets, the better money you're going to make. And you make money in 2 ways. First of all, you make a discount. Let's use it, let's compare it to land. Imagine there is land which is worth 10 million. You can buy it at 10 million, you can buy it at 11, or you can buy it at 9. Where if someone tells you choose which one will you want to buy it, you want to buy it at 9. Why? Because you save 1 million. So the treasury bonds are like that. Interest rates go up every single day. They change, not they go up, they change every single day. And every day they change, it's the decision of you paying more money for the same bond or paying less money for the same bond. So why is it important to, why do I start from that? And I know someone said I should go back and explain this. The coupon is fixed. It will never change on a bond. If bonds are issued by the government of Uganda through Bank of Uganda, the coupon is set the first day the bond is auctioned off by Bank of Uganda, and it will never change no matter what, right? Can we keep the questions later and I come and I understand I don't miss them? Because the next 1.5 hour session, I know for the next 1 hour, we won't be talking about bonds fully. So let's keep them and we'll go through them. I don't want to miss them. Coupons are set on the first day. They never, if a bond is for 20 years, that coupon never changes. The interest rate can change every single day. Not it can, it actually changes. And it's the difference between the price you pay. You getting a premium bond or you getting a discount bond. I always recommend try to get a discount bond. And the only way to get a discount bond is by making sure the bond you are buying is at its interest rate is as high as it gets. So it's important for that. It's important for that you have to make sure interest rates are high. Now, when do interest rates go up? Every single time there is an event that is impactful. Every single time there is an event that is impactful. Raymond, I'm coming to those because I'm starting to enter the territory of real treasury bonds. Every single time there is a bad news, the investment world reacts. Right now, we are about to enter into elections. The investment world reacts. Give me a minute.
Anyone feeling fired up now?
I'm here, guys. I'm here. I'd taken a minute. I was starting to enter that investment world is interesting. Every single time there is something that happens let's focus Uganda. In Uganda, it impacts investments. It impacts treasury bonds interest rates. But to explain this better, let me use Kenya for the last 2 years. It will bring out better than we can project to Uganda. We shall use Uganda. In 2022, when they changed the presidency, it meant systems had to change, new people. At the time, Kenyan Treasury bonds were trading at, the data is here. At the time, when Ruto came into power, the Kenyan bonds were trading at, give me a minute. This is 2022, they were here, they were trading at 12%. So almost all the times of Uhuru, they were trading 12%. So Ruto comes in, he comes in at around October here. They're at 13%, now they're starting to factor. Actually, he saw in around October, then the market starts to price that in. Corruption, after problems, they had the Euro bond, the government was broke. And they needed to borrow money. By the time they reached June 2023, last year, the noise and the smoke, especially online, was too much that the government is going, they have no money, they are not meeting obligations. For those of us who monitor the internet, to us, that was an opportunity to invest. Especially, we're going to come back to that later. And from there, interest rates in Kenya jumped. In a space of 12 months, 6 months, they jumped from 13 to as high as 18. You can see at 18. By Jan this year, people in Kenyan bonds were making money. Ay, my God. 19, 18, 19, every bond that the government was issuing was 18%. 18%, to give it to you into context, it means if you compound that bond, you can double that money in 4 years. 4 years. If you buy a 10-year bond, in 4 years, you have all your money and you start eating it. If you invest 10 million, in 4 years, it's 20 million. In 8 years, it's 40, and just eating profits alone the rest of the time. Then they started engaging IMF. By June here, IMF had given them 1.5 billion and the interest rates came down. But then that's when the Gen Z election demonstration started. The market hates noise. It went up back to 18. Now the presidency, they did the control, they channeled everything, they controlled everything, they brought it back. Now the rates are falling like mangoes. In the last 3 months, they have moved from 18. Now they are back to 13, 14, which we anticipate by January next year of Feb to go back to 12, where Kenya should be. That's how interest rates change every single day. And they change and they impact the treasury bonds. Let's use Uganda. Let me use a particular bond in Uganda that will demonstrate this. Let me use this one. And this is live data, by the way. Direct data, which banks look at when they are if you are to go and buy a bond from them. So this bond was issued in 20, do it weekly such that it's not too small. It was issued in 2020. In 2020, it was issued, it had a coupon of 17.5. But around that time, the government cost was so low because we were in COVID, everything was closed. Like that COVID, people, the private sector suffered, the government sector never suffered. No per diems, no, so the spending was so low. So all through 2021, let me come back to Flavia to that and I explain it. All through 2021, the interest rate were just falling down and they reached around 14%. In 2022, the government, what was happening by 2022 after the COVID years, the government had to re-inject the economy to start again. The economy was on its knees, and even after the election of 2021, it was on its knees. And to do that, they had to start borrowing more. The markets understood that the government needs more money. The rate started going up. By end of 2022, they were at close to 18. Then they had covered it out. Then we enter 2023. They come back to 15. Now, that's when I think the event which brought in 2023, that's the first budget reading of the new speaker. People believe that that event also impacted the market because now budgets and of the economy, they pass in and out. Politics impacts bonds as much as possible, by the way. So all of a sudden now it had to go up and it has maintained around 16%. What that means is everything impacts interest rates. Even long term, in the coming months when we are going to go into the elections, interest rates are going to go up. But that's just one side of the story. When we look at this, where we say interest rates go up, and maybe to answer Flavia's question specifically, when you buy the bond for the first time, the coupon is locked in and you pay the price there and then. The subsequent investments you make are on a different yield to maturity. So if you buy a bond right now at 17 or even 16 interest rate, in May next year, the interest rate might be at 18. You want at that point to have another 1 million to be investing. But that's one side of the story, which is the profits, the return, how good they are. The opposite is what is the risk and how do you mitigate the risk? I don't know if all of you here who are here are subscribed to my article. There is an article to my publications. There is an article that's coming out on Monday. It's going to be extremely helpful. But the risks of investing in a treasury bond is, and foremost, is a government default. Government not paying you back your money. Now, governments do not default like you and I defaulted. Okay, if you as Anne, you give me 5 million, I refuse to pay you. No. The government of Uganda started offering treasury bonds in 1969. Since then, those are close to 50 plus years. They have never defaulted or had a defaulted event. Even during the hard years of politics of 1979 to 1986, the government paid. Does that mean it cannot default? No. But it's the limitation to default is limited. But what could trigger them to default? Those are the events you should pay attention to as an investor and try to see you making a decision based on them. Give me a second. Sorry about that. So I was saying, when you want, default is possible. You have to assess what can trigger default. There are 3 things that are very important, and especially for the context of Uganda. The first one, political instability. Now, not the demonstrations on the street. Those will not trigger default. Political instability can be 2 things. You have to sit back and ask yourself, as in Uganda, do we have a transition plan post-Museveni? In Kenya, they know every 10 years they elect a president. For them, they are past that risk. But for us, when will it happen? Do you have confidence in the transition that the government seems to be taking, that maybe it's going to be Moho's? Politically speaking, you might hate it. But from an economic point of view, if you know that is a likely transition and it's going to be smooth, however much we hate it, there's not going to be instability, it means there is the risk of default is minimal. Because the political heads will transition, the economic heads continue to move on and operate. Treasury bonds are not operated by ministers and leaders and MPs. They are highly competent, technical people like you and I, employed, they're civil servants, employed in the Bank of Uganda and Ministry of Finance in the Treasury Department that run this. So for as long as the politics of the day does not so much interfere, they can't so much default. So if the event of transition is to Museveni, to his son, or to someone similar, then the risk of default is low. If the event of politics is we might have significant demonstration that might even lead to a coup, or where the government overthrown, where they have to suspend every democratic process and the economy goes to a standstill. Like best example I can give is Niger, right? That always triggers suspension of everything, even coupons and bond payments. So that's a default. The question you have to ask yourself is, how likely is that possible in the next 10 years, 15 years, 20 years in Uganda? My assessment is, and let me talk about for Niger, even in the coup, they suspend payments for, let's say, 6 to 12 months. After that, I'm coming, Carol, to that. Thank you so much. After that, they resume payments. Even in the coups, they will suspend payments. The economy, the guys who, the new leaders get control of everything, then the government has to run. The third event is if there is a transition of democratic process that we go into an election in 2026 or 2031 and the opposition leaders, they take over. What happened in Kenya? There is no default in that transition. So you have to assess the political risk in that and say, what do you see might happen in Uganda? It's more likely than not that it's going to be the option one, where Museveni might just anoint someone and they take over. And they have grip that there is not going to be so much instability that will put the government to a standstill. So then the risk of default might be minimal. The second event that might happen is if the government has no money, no politics, no whatever, but the government is broke. In Uganda, at least right now, the URA is trying every single thing they can to raise the tax base. But two, that can also happen if the big institutional investors, the banks, the insurance companies, are unwilling to lend to the government. But for as long as the banks are willing to lend to the government, there will never be a default. And what we are seeing is the banks are more willing to lend to government than to lending to me. They are more, that's why the government will call for, it will want to raise just, let's say, 100 billion, and the banks will give it 500 billion. They go yearning, take my money, please. Take mine also. For as long as the government still has access to that untapped cash from banks, insurances, and outside institutional investors, you have to worry not that there will be a default. But you can monitor. It might be right now that way. Maybe in 15 years, you might start hearing the sentiments that the banks are starting to be worried of the government. Then at that point, you want to be like, okay, so let me not to invest. Let me even start selling what I have and I put it somewhere else. But in the next 10 years, for as long as the banks are like NSSF, pension funds, everything, because you and I are literally lending to government how much? 5% of what they need. The big people who own 95% of the bonds are your bank, which is your money actually, your deposits. NSSF, which is your provident fund. Insurance companies, which is also your money. The bonds are sitting at the core of the financial system of Uganda. That's why the risk of default can be easily catastrophic, and the confidence, and that's why even it hasn't even yet happened. And this doesn't happen in Uganda alone. Globally, treasury bonds are everywhere. So if someone, my friend who is in West Africa, Ghana right now, it's offering 22% on treasury bonds. And someone will say, but wait a minute, Ghana defaulted on some bonds. They didn't default. Those were euro bonds, dollar bonds. They delayed the payments for 90 days until IMF came and gave them the money, and they paid again the people. So that is the risk. Now, I've talked about the profits, and we're going to talk about the profits more you can make in treasury bonds. But I wanted to highlight the risk that comes with it, the risk of default. The other risk is the risk of inflation, but inflation is not limited to treasury bonds. The risk of inflation is everywhere. Inflation means you have 1 million today, it can buy you 10 bags of sugar. Next year you have 1 million, it buys 9 bags of sugar. That 1 million, it doesn't matter whether it's in bonds, in land, in business, inflation eats you away the same. The good thing in Uganda, inflation grows at a slower rate. The technical people, I give them their kudos. They manage it. 4, 3, 4, 5, 6. So for as long as the bonds are giving you 16%, your what we call the inflation, the real return is 10% and above, you are good to go. Now, having said that, now let me bring the real good side of treasury bonds. To maximize treasury bonds, we talked about it for land, but now let's talk about it in this regard. You have to accept the best way to make money out of bonds, you must compound them. And what does compounding mean? Today, if you have 15 million and you invest in the bond, it means every 6 months they're going to be giving you close to 1 million. Please go and reinvest it back. Allow the money to grow. There is one of the best books I've ever read, is the Richest Man in Babylon. It has one of the best concepts of compounding. It says, you be paid gold, 1 gold. Go and invest it for it to bring in 10 silvers. I think it's something like that. Then when you get the 10 silvers, take it back to the investment for it to bring in 30 bronze. When you continue doing that, one time you're going to wake up when you have 3 golds, 100 silvers, and 1,000 bronze. But you'll be much better off. The other way, the best way to use concept of compounding is what we can use, what we can relate to. Most of us are from Uganda, can relate to this. If you have ever had rabbits or mumu, they are the best concept of compounding. You bring 2 rabbits at home and create a gazette for them. In 1 year, you're going to wake up when you have 100 rabbits if you're not careful. Because for them, they get pregnant and they give birth every single month. And when they give birth every single month, the other ones, they grow in every 3 months, they also give birth. Before you know it, the kids, the grandkids, they are more. Or even if you have to use the compounding element in a human, or let's say even in a human element, is for you to say, I come from my great-grandfather and my great-grandmother. They had 5 kids. The 5 kids have had us, our cousins, and everyone, we are 30. The 30 of us, we have had so far 50 kids. Now, this whole family that starts with our grandfather, there were 2. Now that whole family is a family of 80 people. That's compounding. In a treasury bond, all it means is when they give you the coupon, If you don't need it, if you at that point, can you reinvest it? And someone asked that, and they added the question, is it a silly question? Can I buy the same bond? Yes. These bonds are on the market for a period of, let's say, 10, 20 years. If indeed your goal is to have one bond and keep accumulating it, you go and buy that exact bond. The problem is, no, the challenge is at one point you're going to be buying it from the secondary market. And secondary market means you might end up paying a premium. Now, let me talk about it at this point, primary versus secondary market. Primary market is when you're buying from Bank of Uganda right away. Highly recommended. Secondary market is when you're buying from banks and insurance companies. So if there is a bond that you want, and that's the bond you really want, for example, this 20-year bond, case in example, it was sold last week. It's going to be sold again in Feb. But you have money you want to invest right now. The primary market is locked, it's closed, it's not going to sell it till Feb. So what do? You go and buy it on the secondary market. The opposite is you go and buy something different. So those are the primary and secondary. Primary market from Bank of Uganda. Secondary market, the banks. But coming back to the concept of compounding, it means when you start with 15 million, when the government, it's at 14% right now minimum. When the government gives you this money, every time they give it to you, you go buy more bonds. Let that money grow, especially if your concept. I know I have a friend of mine, a client of mine here on this call who is about to retire in 3 years. Now, their goal might not be to grow their money in the next 20 years. I have someone here who's like, I may be 30. For us who are in the 30s, you can say, I'm investing for the next 30 years. So compounding matters to us. We must keep whatever profits we make, put in. Whatever profits we make, we put in. And if we make even more money outside in the salary, you add in. Assume you started with 15 million. Every 3 months, you get some other 500K. You add it in. That means in a year, you would have added how much? 500K times 4, 2 million. And if you do it that way consistently, from 2025 until when you make 20 years from now, which will be, these are many years? These are 16 years. You can see, you would have moved from an investment of 15 million to an investment of 200 million. Why? You have allowed your money to grow over time. That's compounding. It does not necessarily mean you need to invest in the same bond. You can invest in the bond of the day. What brings in more money when you have money is what you have to buy. You might wake up one day and you have 20 bonds, which brings me to the question someone asked of bond ladering. Bond ladering means you having more than one bond that bring in different cash at different point in time, and they have different interest rates. So to some people, it matters that cash comes in every single month. Like a client here on this call who is about to retire. To them, they're going to retire. That means if you retire and maybe you have just pension or you no longer have a salary, it means you must establish an investment that brings in money every single month, because for you, you're going to spend. At that point, for you, your concept is not compounding. So if let's assume the person has maybe a 50 million somewhere, that's what they start with. So for the next 3 years, they are still in employment. They do not need to touch that money. They need to allow it to grow. Then by 2028, when they finally retire, the bond is now bringing in 10 million. But they know this investment is what must feed them going forward. And they know they don't rent, they do not have any issue. So potentially, they need to get to live on 1 million per year, per month. So they need to withdraw 1 million per month. So that means at that point, they stop the compounding and take out the 1 million per month. Okay, that's true. That's too many zeros. Right? So all of a sudden, they compounded for a few years, and then they started using that bond as a concept of feeding themselves as a salary. It creates cash flows. So to do that, you must invest in more than one bond. So if you are someone here, another client who is, my assessment is maybe 45 years plus, and you say, I might be retiring in the next 10 years, and right now you have a 50 million, that means you don't withdraw anything. You want to start with your 50 million and keep adding in maybe a 1 million per month. And if you do it that way, okay, the formula terrible. Boom. Next 15 years, you have $1 billion. For some of us who are on this call who are in between 28 to 38, we have over 20 years to go before we retire. At one point, the goal is going to sit you and say, I would want to retire when I have a fund of $1 billion. For the first time, people are listening to say, okay, people are listening to this, that you can make $1 billion. Like, I'd never dreamt that. I can see the money you're talking about is possible, but I'd never dreamt that. And I'm like, this is the good thing with treasury bonds are easy to predict. It's as simple as saying, I tell people, do not worry. Join my client base. You want to make $1 billion? Yes. By 2040, yes. Have you understood the questions are simple as this? Have you understood the risks I've talked about? Yes. Should we move forward? Yes. Someone is trying to join. I can't see them, so someone can help me add them. So the question becomes, do you have 50 million right now? Yes. Can you raise for me 1 million per month? Yes. That's it, all I need. Let's do this. Yeah, Vanessa, I'm coming to that. You bring the 50 million, we invest it the best way possible. Every single month, we sit down and deploy that. I assure you, by 2028, we shall be at that, close to that amount. By 2031, we shall be close to 50 million, and the magic starts happening from there. Because you realize the day you cross 200 million, you start making it close to 30 million per month, per year, which is almost 3 million per month. And then magic happens. So for those of us here who still have time ahead of us, start now. Especially if you still have some resources. Now, I might say, okay, 50 million is so much. I don't have that. Yes, you have 55 million. And you can raise just 200K a month, per month. So you start with 5 million and you dedicatively put some 200K here. At one point, maybe you can say, I can increase it. By starting with 5 million, you give your chances in the next 16 years to one day wake up when your total bond portfolio is close to 170 million. Now, the people are going to wake up and they have billions, but even you will be happy because what you started with is that, and you have been putting in just 200K. The rate you both of you are getting is the same. It's just that the other person has put in more money. And that's why you say, when people are investing in bonds, I tell them, start with as much gear as possible. But even if you just start with 1 million, have the commitment and the discipline to commit every single month or every 3 months, putting some money into a bond. Just keep buying. Understand the risks, they are minimal. Keep buying. If a time comes of someone who asks, can I sell my bond? Yes. By the way, selling a bond, you can get that money in less than one day. You just have to make sure you target when to sell and how to sell it. That's why you have to talk to advisors to tell you what is the price. If you buy a bond today and in 2 years from now, you're like, oh, I need this money. Yeah, you can sell it. You would have got your coupons for like 3 months, for 2 years. If you have been compounding it, you can sell it. And you get your money and go do it with whatever you want to do with it. Though I highly recommend people to always have diversity. Invest in unit trust for your emergencies and invest bonds for your long term. You have kids, invest in the bonds for them. Open up an account that is in their names and start funding it. When it reaches 5 million, buy a 20-year bond for them. God knows this Uganda is going nowhere. An obligation by a government never goes away. Never. Forever. Even if that's why you see, even the Asian guys have come back and government is paying them. Even if government of the day comes and it says we are not paying for the next 18 months, all they are doing is to delay to get in everything in order. The new government will pay. So your child is going to be there in 20 years from now, even if you are 60 right now. For them, they will be there. They will get that money. So when we talk about default for the government, it's not like you lending money to Kakande and I disappear on this tiny island. You'll never hear from me. You have nowhere to go to. There is the price premium they put on governments, on a country, on the sovereignty of the country. That's why globally they say treasury bonds as an investment is the safest investment. Safest. Even when they talk about the risks of default, they're not talking about outright delay of paying you. Simple things as delaying a coupon was supposed to be paid last week, you have not paid it in 30 days, that's a default. So the concept, and now I'm about to go into the question. There are 3 concepts I've covered in this particular session. I'm going to come to Leonard to that. The concept of compounding, the concept of laddering, and the concept of you willingness to have the discipline to keep buying bonds. If you sit down here and you say your goal is to have $1 billion in 20 years, you have a plot of land that you don't know, it has not yielded any profits and it's sitting on a 30 million. That's the first thing you want to first sell off if you have no plans of using it. And then it will give you a 35 million to start with. Then you say, every single month from my salary or my income, for as long as I'm employed, you're a civil servant, you're going to sit back and say, for God's sake, I can sacrifice a 300K or 400K without me losing anything, without me ever feeling like I'm losing too much. That 400K, you say, I'll keep buying a bond. The minimum amount you need to buy a bond is 1 million, is 100K. But you don't need to even buy a bond there and then every time you have 400K. You can say, I'll accumulate it every 3 months. I put $1 million into a bond. It's the same. If you do it that way, 35 million and 4.8 million per year, you give in the next 16 years, you'll be at 530. If you compound it for 20 years, yeah, 2045, you'll have a close to $1 billion. But how much would you have started with? 35 million and committing 400K. And this number I'm using at 14% interest rate. 2 things. When that interest rate goes up, you will make more money in a particular month. Yeah. If the interest rate goes down, you make less money. So that's why I've averaged it and I said, for the people who invested in 2020, in 2010, 2005, are here. Right? They started with 35 million and they were getting an average of 19%, even if you put it at 17. And if they were adding there even if just 200K times 12 per year, 35, 200K from 2000. Assuming someone tipped them off, I can even start with less money at that time, 15. Someone should help me admit someone who's trying to join. At 15 million, you do it 2 million. Right now, that person is a billionaire. They are getting almost 200 million per month, per year. That is close to 20 billion per month. So sit back, and sometimes I always challenge when I have the elders, and I'm like, think about it in 2000. How many of our fathers or grandfathers had some 15 million? Does the change in interest rate? Okay, now, after doing the compounding, now I know. Allow me to go to the borrowing, and I come back to answer some of those questions. Imagine, Godfrey, let me come back to those questions. Let me finish off this, then I come to the questions, because most of them are interlinked. Imagine right now you say, I don't have money to invest, but I want to invest. And I'm going to be given a loan. Should I borrow to invest in a bond? Yes and no. Yes, if it's a numbers game. So imagine you can get a loan from a bank of 50 million at 21% for 7 years. Should you take that deal and go buy a bond? The first question I always ask when someone tells me such question, I'm like, the 21%, is it fixed or reducing balance? That question is important. Someone is trying to join in. I hope. Maweje, is he in? I hope they are not missing out.
Yeah, they keep on dropping off and
Okay.
back on.
I'm assuming. I hope they are not getting calls which distort their internet. I'm sorry, but that makes the experience, but it's recorded. I'll try to what. So let's focus on this. 9% for the loan. Vanessa, for the loan, if it's going to be 9%, I'll tell you, you borrow right now. I'll tell you, you borrow right now. But let's use, why I prefer to use the highest interest rate is for you to see the picture. If you can get the loan at a lower rate, then means we're even much better off. So let's use an average of 21%. And I will ask you, is it fixed rate or reducing balance? If you're getting that loan from a commercial bank or from workplace loans, they are always reducing balance. You should make sure it's reducing balance. It's hard to go into details of what it means, but reducing balance is the best loan. A reducing balance loan of 50 million for 7 years, you will pay an interest of 945 million, and the total amount you would have paid is 95 million. So in the 7-year period, you're going to give the bank a total of 95 million. The question is it worth borrowing 50 million to invest in a bond? The question is answered. How much will that bond be? If I get the 50 million and I buy a bond, then we come back to here. I will send a simulation of this Excel to you for people who want to look at it later. So no additional capital. We don't need that. So here you have borrowed 15 million, 50 million. I'm going to reduce this to 13 million. In finance, we always want to be conservative. I want to use the worst case scenario to make the best case possible. So at 50 million, if you get it, and right now you get a bond, a fixed bond of 13%, but you are willing to compound, you are willing to reinvest every coupon you get from the bond back to allow your bond to grow, because most times you don't even need that money. You still have your salary, you can survive. You want this portfolio to grow. If you do it in the next 7 years, this loan is for 7 years, the bond is for 7 years, which means it expires in December 31. So it's your cutoff period. That bond would have gone up to 117 million, but that's using a 13% interest. If it's 14, it goes more. If it's 15, it goes more, but let's use 13%. Okay, 13%. At 13%, you would have made a profit of 20 million. Now the question becomes, from a numbers perspective alone, it's okay, I would sign off on a 21% loan, 13% treasury bond fixed. You will make money, you will make a profit. For someone who's going to get that loan at 17%, you're going to pay 85 million in profits in the total amount, but yet your bond is going to be 117 million, which means you're going to make a profit of over 30 million. For someone who's going to access the loan, Vanessa, I'm assuming that's your workplace where you're getting a 9%. Let me put it at 12. You're going to pay 74 million over a 7-year period. Yet the bond is going to give you 117, which means you are making a profit of 50 million. The lower the rate on the treasure on the borrowing, the better on your borrowing. So you have to pay attention to the rate you're getting for your borrowing before you borrow. So having said that, now let me go through the questions for the next 20 minutes. And I know we have a time, but sometimes you can't leave anything. So I'm going to go back and start from where they are. Someone asked, and I know I've been answering some of those for when it comes to the treasury bonds. When you are reinvesting, when someone who talked about the compounding, when you buy a bond, like for example, the someone who bought a bond last week, its interest rate is 17.5. I assure you in Feb, it's not going to be 17.5. It can be 15, it can be 16, it can be 17, or even 18. What I encourage from a finance perspective is you should set a bare minimum that below this, I would rather not invest. And this shouldn't be in treasury bonds alone, it should be in your investments. I know for sure, and the outlook of 2025, like someone asked the question, they are going to make above 25%, above 15%. So for as long as the bonds are still offering 15% and above, you can compound and double your money every 5.5 years. So you are good to go, right? So your goal is to say, for as long as the bonds that are still being sold are more than 15%, I'm happy. I'm happy. Now your goal should be the floor should be 15%. The ceiling should be, yes, let's enjoy the money. They bring 18%, you have $1 million, you invest. They bring a 16, you have money, you invest. They bring a 15, you invest, because they bring a 14, you're like, no, I will not invest in that. So that is it. Lawrence is asking, which brokerage firms is it? And I will answer this with someone who asked, how do they start? I think they want to start. Treasury bonds, the best way to buy treasury bonds is through your commercial banks. All of us have banks in Uganda, I'm assuming. All you need is to open up a CSD account. It's a simple form. It's a 2-page form. For as long as you have a bank account, you can easily open up a CSD account. And when you do that, that's how you buy bonds. You can walk in to your bank on Monday. They will give you the form, you sign it off. On Wednesday, you'll have your CSD account. On Friday, you are investing. What is a CSD? It's the Central Securities Depository Account. That account is in the Bank of Uganda. Remember, all treasury bonds are housed in the Bank of Uganda. That even if your bank is to close what the Standard Chartered guys right now are looking at, your bonds are safe. They are not with Bank of Uganda. They are not with Standard Chartered. They are with Bank of Uganda. Bank of Uganda is where all your bonds are housed. Standard Chartered is a conduit. You do not go yourself to Bank of Uganda. You go through a commercial bank. So to start, go to your commercial bank. Open up the CSD account. You might not remember the word CSD. Just tell them, I want to open up the bank account for the Treasury bonds. They know the form. It's a one-pager form, and that's it. Do I need to buy the same bond for compounding? I've answered this. I would say no. Actually, if you do not have an advisor who you can always consult on which bond to buy, the simplest way is to say, I will always buy 10-year bonds. Just put it in your mind, I will always buy a 10-year bond. For as long as they are selling a 10-year bond or a 15-year bond or 20-year bond, I will buy. Just keep buying. It will automatically compound itself. It will automatically ladder you. But the better way is to say, especially if you have some good money, get an advisor. I tell people, my full-time clients, we charge them in a year, a full year. That means in a year of offering service, you end up charging someone, let's say, 600K. Yet you have made them money of 20 million or 30 million, depending if they have money. Or you offer someone a service for a full year and you charge them 1.5 million, and yet you have made them over 30, 40 million. It goes a long way to serve that, right? So get an advisor. Get someone you can call and say, by the way, I have 5 million. Where should I put it? I'm like, oh no, 5 million. Something is coming up in the next 2. My ear on the ground is telling me next month is the better way to invest. Put that money on a unit trust for now. 0 cost. And I offer that. 0 cost. But I've given you something to do. A month later, I'm like, time to invest. Please make sure you fill in the form. They fill it in, take it to the bank. Make money. Like, something like that. The same way these days they say it's good to have your personal lawyer. It's starting to be. Even us now in finance, we are starting to also feel some weight. Yeah, guys, come, please. It's that way to say, have that. Have someone you can easily benchmark on an idea. I want to buy this. I want to buy a plot of land here. Do you think it's a good investment? Let them look at it. They're not going to charge you every time. No. At the end of the day, the cost of having an advisor should be the net benefit, the profits you are making to have something like that should be more than the cost you are paying them. So, to that end, can you talk about laddering? Geoffrey, I've talked about laddering in that regard. Can you talk about how to go about if it's to borrow money? Vanessa, I've answered that. Does the monthly investment mean you have to keep going to the secondary market? No. Bank of Uganda sells a bond every single month. If your goal is to buy bonds from the primary market, just keep buying whenever Bank of Uganda is selling. One time you're going to reach a point and you're going to, I'll give you an example of this chart, right? One time you're going to reach a time and you have like 10 bonds like this. And they give you a certificate and you're like, you have 1, 2, 3, 4, 5, 6, 7, 8. Just keep buying. It will compound, it will make you money. You'll start getting money on your account every single month. You're like, oh, the bond has paid. Oh, the other bond has paid. Oh, you just keep buying. Your goal should be that your goal is that you should be having a 500 million. So before you hit that goal, just continue buying and buying and buying. If your investment, your coupon payments in the same bond as the new yield, yes. If you keep on reinvesting in the same bond, the yield to maturity keeps changing. So it blends out, but the coupon never changes. But that's why I said set a benchmark. Sit back and say, my benchmark is 10%, is 13%. Where is that Excel of ours? 13% return. As long as I have that, I'm good to go. Just keep buying. Is it better to save and invest, Godfrey? Depending. If all the money you have is 200K per month, I would say use the unit trust to accumulate it to every time you get $1 million, then buy a bond. So this is what I mean. Every month you have 200K. Open it up a unit trust. Every month you have that, send that to a unit trust. Every 5 months you make $1 million, buy a bond. Save in a unit trust, buy a bond. Unit trust, buy a bond. How does one reinvest the coupons? Reinvesting the coupon is the same as investing more money. Remember, when they're paying you coupons, they pay that money to your bank account. So assume you buy a 20-year bond, this bond, this one. It's paying a coupon on 9th January 2025. It's going to pay someone, whoever invested 30 million, it's going to pay them a 2 million. That money is coming to your bank account in Standard Chartered, in Stanbic, in KCB, Africa, whichever, housing finance. When that money comes, chances are you'll even be having an extra 1 million or 2 million to spare. Now you top it up and buy another bond. It's as simple as that. Compounding or reinvestment is more behavioral. A decision to keep compounding. Bank charges. When you're buying treasury bonds, a bank charges you only 23,000 to buy for you a bond in the primary market. 23,000. I know some banks which only charge like even less than 15K. I think even them, they're coming to 23,000. That's it. Someone wants to look at the numbers for 1 million for 10-year bonds. So yes, for compounding, imagine if you start with 1 million and you're willing to put, I don't know if you mean also 1 million per month, but let me say, oh God, I did it wrong. So for the next 10 years, that's up to 2035, around here, to grow in from there to around 200 million. Yes, it keeps compounding. Someone is asking to talk about tax. Okay, tax. Treasury bonds, like any other business, is tax. The profits are taxed, not the principal. Actually, this is very important. Let me talk about it from here. The tax is not on the amount you have invested. It's in the profits you make. If your goal, and what I am trying to advise people is, if your goal is to maximize profits, to make as much money as possible, invest in 10-year bonds and above. Their tax is 10%. But sometimes you might need to invest in short to medium term bonds, the 2-year bonds, 3-year bonds, 5-year bonds. Those, they attract a 20% tax on the coupons. These numbers I'm showing you here, this 13% interest is after tax. Otherwise, the yield is not 13. I cannot buy a bond of 13%. My cutoff is 15.5. You know, if I'm to use 15.5, it's a different number altogether. So this one, this 13% is after tax. I'm going through the question as fast as I can, make sure I'm answering everyone. How much to compare buying from the primary market and the secondary market? If you have less than 200 million, if you have less than 200 million, I would recommend you buy from the primary market. They sell those bonds in this month. But if you are now, you know, people, some of you have money. You are sitting on a 400 million. No, you cannot buy in the primary market. Come to Kakande, we shall go and negotiate, and I'll get you a very good deal. Close the primary market, and you'll start earning right away. But it's highly recommended, as you are starting, you buy from the primary market. Why? The secondary market requires negotiation. It requires you to be in a position to know how the prices of bonds are trading at any point in time, any day. And you see here the prices, they are changing every single day. Let me put it in for 1 year. See? So you need to be in a position to know you're going to go to negotiate to the bank. Now, if you have just 20 million, no, wait, go to the primary market, you'll get a very good bond. But you have 400 million, you can afford 300 million, 250 million. You can afford a Kakande to pay him 450K for him to come for his to this, to see what the price is. That's what the bank are trading at, to go and invest and negotiate with the bank and get your right deal. So, but highly recommended is the primary market. Unit trust, I met someone, let me answer. Unit trust accounts, I met someone who was signing people up. Is it okay to sign up with them? Be careful, eh? And someone I tried even to respond to you. For example, and let me not mention the brands, the same unit trust brands have this education and other products. When they assess that you don't know what you want, you might end up being signed up to something that you wasn't the intended thing. That's how people have ended up in certain policies that they thought were investment policies. You can afford to be on this call, you have paid the money. You can afford to go on the internet and say you want to invest with company A, Sanlam. You go and type in Sanlam Money Market Fund and get the contact for them and reach out and say, send me your forms. For a moment, even if you're not so sure, send me a text and say, Alex, is this form right? The one I'm filling up. These are free. You have already paid us for our services. I'm all for giving back to people who are really interested in finance. Big bank me and say, this person has sent me, is this the right form? I have to fill it up. I'll be like, yeah. Oh, I want to invest in this money market fund. Who should I contact? I have contacts throughout all of them. I'll give you a contact, and they know. If Kakande sent me my person, do not try to sell them something else. If that wasn't the case, what they were looking out for. Sorry, I'm going to do the questions as fast as I can. Kindly recap on yield to maturity and interest rate, as well as buying at a premium or discount. Not right now. Yes, Martin, I'll try to upload it in a way that people can access it. Right now, most bonds, especially 10-year bonds, are at a discount. Why? The interest rates are higher than the coupons. To better put it, let me put it this way. The government is in need of money. Every time the government needs more money, it's willing to give people a discount. But it's not always the case. Not all the time you're going to buy a bond at a discount. Especially buying bonds, which are in high demand, it attracts a premium. Premium means the bond is 1 million, but the government is selling it at 1.05. For example, here, let's assume you're buying this bond in Jan. And at the time of buying it, let me say it now. Next week. And at the time of buying it, someone gives you an interest rate of 15.5. See, you're going to end up paying more money than the bond worth. You're paying 900K, so you're paying a premium more than the bond you are getting. Why? Maybe because at the time of your purchase, it's in high demand, or you didn't negotiate very well, so you went to the secondary market. But even the government sometimes sells bonds at a premium, by the way, when they know the bond is so much in high demand. So, but the goal is the premium should not deter you from buying a bond. For as long as you say the profits you're going to make on, you set your ceiling and say, for me, if you can take anything from me, you just say, for as long as I make a 14% return per annum, net profits, I'm good to go. You should be investing. Advise on those who require your services, how we can reach you. My number, my WhatsApp number, I'm putting it in the chat. Anything you want to pick back, just reach out to me and we can talk about that. That's a good question. If someone who is abroad, now this can be a long conversation, but let me put it this way. Let's assume you're abroad and you can raise, I'm going to use your money, 300 million. And you get a bond, let's say at 16. That means you pay just 300 million. Every year that bond, every year that bond is going to be making you in 2025, 40 million. So let's assume this money, actually, let me use the real money, like 360, that's 100 grand. This is $100,000. So this bond is going to be making you 48 million. You do the translation at 37. That's $13,000. Now ask yourself, at 30, even if every time they give you back this money, you take it out of Uganda and bring it back where you are. There are very few investments you're going to do in the UK, in the US at 100 grand and give you 13 grand after tax. So you are good to go to invest in Uganda. I'm past the time I had allocated. So the next 3 minutes, I'm trying to see which questions I've not answered. Flavia, 15% after tax? No, 15%. My 15.5% cutoff is gross. My net tax after tax is 13.5 personally. And it allows me, but I know right now we are in 14%. So for as long as you are keeping on investing, you're good to go at 14%. What question have I not answered? I've answered Fiona. Bank charges, Vanessa, I've answered you. Does BAU have enough bonds for everyone? Yes, for retail investors. Your bond will never be rejected. It's only banks where they reject some of their bonds, because for the banks, they charge, the bank is going to bring in a trillion, that they want bonds of $1 trillion. Of course, they're not going to give it to them. So for you, they will always accept it for you. The one in the UK, you reach out on my number and we talk on my fees, because the services are different and how I structure them is totally different. Discounted bonds, you might not know how when the bond is discounted. You just have to trust that for as long as you keep buying from the primary market, you get a better bond. For as long as you need to invest, you just keep buying. And two, I make commentaries on this. I know someone has brought it up now. I might talk about it, right? Almost every single 2 weeks or 3 weeks, people who follow me, they know I write on this. You can see they are close to 200 articles, 70 to come. They are already to come, 6 in drafts. It will give you so much on what to talk, to learn about bonds and investing. So much more. So I'm putting the website here for those of you who want to learn more. Every single now and then, even if there is an event that impacts treasury bonds, I will always write about it. Investing in the Kenyan market right now, you can, if you are in Uganda and you want, actually there is an article that's coming out, Brian, next week on the Kenyan investments. Let me see, when is it? on December 16. So if you are to invest in the Kenyan market, in the bonds, there are things you need. You need a TIN number in the Kenyan. It's the hardest to get. But if you can get it, then I recommend you to start investing in the Kenyan Treasury bonds. If you want to invest in unit trusts in the Kenyan market, you can pick bank. You can reach out to like KCB banks, Equity, ICEA, Old Mutual. They have counter companies in Kenya, and they will tell you which companies they can connect to you to start investing in the Kenyan economy, which is good and recommended in that regard. Guys, I'm past my time, but I know this can get. Vanessa, I've answered your question. Brian, I've answered. Having 3 unit trust versus 1 unit trust is in terms of return. I would recommend, if the only money you have is 10 million and you want to split it up in 3 unit trusts, go for it. Someone might be late to the party. I don't know who has invited them, but they might be late to the party. Marion, split it up. Give these companies 3 million. Monitor them for 3 months and see which one is giving you more money. They have to give you a statement every single month. After 3 months, the one which is giving you more money is one which you should add more money to it. Marvin, yes, you can. You can get a loan using a bond as security. Banks love it. But some loans officers do not understand it, so they might tell you no. So you go to the real branches and tell them this is what I want to do, they will do it. Olga, no, it's not per interactions. Most interactions are going to be very free, by the way. They are very free. And it's not per year. It depends on what the services are. But at any one point in time, the cost of my services is, the times you're going to reach out and you want something very simple. You want a 5 minutes conversation. That 5 minute conversation, even I know I cannot charge it for you because maybe we had a 1 hour conversation a month ago and you had already paid me for that. So it's not, I cannot give you a direct cost because different people require different services. Leonard, do banks provide? Yes, they do, but I would highly recommend you not to get a bank advisor. The bank for them is, the best way for them is to make money out of this. So you get an independent advisor who goes to the bank with your arm. For them, every advice the bank does is to make money out of the decisions they are giving you. So for those of you, I put my number in the chat, but I'm putting it again. WhatsApp, you might not call it. You might not go through for it's on WhatsApp. So in that regard, future master classes, hopefully next year. Can you see a CV form signed electronically, if not in Uganda? Michael, yes, if your bank, you might want to interact with your bank. Most of these questions are, let me put it this way. I know we are done with the presentation. Most of the questions are one-on-one or for circumstances which are unique. Whatever it is, just drop. If you have like questions that are following up from this conversation, I'll put my WhatsApp.